It's very interesting about it is that we have been inside of this move here, moving from bust into the direction of boom. And we've really been inside of that environment since right around the May 19th. So there was this little moment here where we came off of our highs, and the VIX had its pullback from its old contract lows to highs. And we were in an environment here where we are creating a bear trap down here. That was that Monday, Tuesday, if you remember, two Mondays ago. And we started screaming higher from there. We were expecting indices to rally on a short covering fuel until the VIX came into at least its 1915s. Well, it went right through it, and the indices have continued to rally here. But what is very interesting, first starting with the regime tracker, is that what we've witnessed today is crude broke a short, and that crude oil short break puts us in a situation where you can actually see this on the futures performance one day. Crude oil is up 6.47%. The S&P 500 right now is, what are we up? We find it on the list here. The NASDAQ's up 0.50. The S&P is up 0.1, so 0.11. So you can see here an incredible change there. What does that mean? Well, we're going into an inflationary type of environment. So we're going from deflationary boom to we're already off of this low and streaking up towards inflationary boom. And the question is, as we move forward here, is does energy outperform the S&P 500? And if it does, we're going to take a turn back in this direction here. And that hasn't happened since May 19th. It's been the better part of 2 weeks that we've been streaking in the bullish direction here. And so I want to make note of that first, because this is kind of all of the markets piled onto one another. We're comparing the S&P 500 and energy, and we're comparing gold and bonds, and this is essentially what tells us where funds are going, where liquidity is going. And I think that you can make a case here it's going back into the inflationary direction. One thing that you can also see inside of the Fed Fund futures is that we have seen the Fed rate hike being pulled into the future into January. Now, we had 7 Fed members last week, and they were all saying essentially the same thing. What they were giving forward guidance for was leaving the door open for rate hikes. Remember earlier this year, this June 17th meeting that we're 16 days away from, there was a rate cut that was being priced into this meeting not very long ago. Let me repeat that. Not too long ago, there was a rate cut that was being priced into this meeting. And now we've gone from rate cut to pause to we have to leave the door open for rate hikes in the future. That's what 7 Fed members have given forward guidance for. They're essentially telling us how they're going to vote next week. So that's the thing that is also very important to note here. The third thing I'd like to just make a bookmark about is the dollar relationship. Now, we finished the week on the 30-day correlation positive, but it did come off of its highs, and the 15-day really went back into the neutral direction. Why is that important? Because if we're not positive and moving in the positive direction, we're moving in the negative direction. The rate of change is towards a negative correlation, which is the natural state of our markets. This stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.